Active versus passive, the Indian market. Assets in passive fund region all-time high, which I showed before also, 11.21 lakh crores, led by positive inflow in this category and M2M, mark-to-market gain, where market rises, your value rises in the underlying market. Other ETFs saw the highest inflow of around 10,000 crores. The appeal relies on the low-cost structure, low expense ratio. As gold prices climb and its appeal as a safe haven asset, standard because of war scenario, other market scenario, gold became a special, always a hedging instrument, adopting a diversified investment approach. The surge in interest was further driven by a reduction in custom duty on gold from 15 to 6% announced in the budget. People are buying gold, and best part is people now are moving from physical gold, gold coins, gold bars. They're moving to gold SIPs or gold ETFs, which is a passive way of investing. Global outlook. How the global outlook, that slide was not necessarily, honestly. 2020 to 2024. Friends, in 24, total ASIV and US passive strategies surpassed those in active ones in the first. That means out there, the passive strategies are more than active, which is gradually catching up in India. About 57% of active strategies survived and beat the average passive during 23 to June 24. So that rules out that always active and underperform. Active also perform the passive. In most of the cases, we can hear very clearly. June 24th marked the end of an outside 12-month period for active bond manager, which 2/3 are performing the average passive counterpart. Nearly 53% of active large cap equity funds outperformed the average index tracking counterpart in the 12th month leading up to June. That means, again, outperformance back then. The long-term performance of active funds has been underwhelming. Over the past decade, the average dollar invested in active funds outperformed the average active fund in 2020. Active bond funds have performed relatively well. What to expect? The period of low interest rate and abundant liquidity following the COVID-19 pandemic is giving way to an environment of high interest rates. Wider variation in returns, the increased market volatility, changing market dynamics, interest will go down, people again go to active fund managers. So passive strategy just might take a slight break. Geographical development, obviously tension, Middle East, Eastern Europe, rise of ESG, growth in EV sector, renewable energy. A lot of things are happening in the favor of active sector. Key matrix. Asset management, overall market value of asset capital that investment fund holds. Often you indicate the size and success of the fund. A larger AUM can lead to lower expense ratio for investors. Not always true, but lower, larger size, the better. You should always look at the AUM.NAV. It is a market value of MF unit. It is the price at which an investor in mutual fund buys or sells unit. Not necessarily higher than or better. It depends on the fund. Load, free leverage of time. Buying units from mutual fund, entry rate, etc. The load, etc. in ETFs is not there. Expense ratio in passive funds is lesser compared to the active funds. Concentration ratio is much riskier in passive than active. Tracking error is basically when you track a particular index and its corresponding index fund or ETF. Lower the tracking error, the better it is. Passive investment marries a particular index. Lower expense, lower thing you should have in your portfolio. Active basically tries to outperform. For fund manager strategy, his selections role becomes paramount important. Active fund management, whenever you make a portfolio, okay, 3 things keep in mind: your age, your risk profile, your time horizon and in what kind of goal you are having. This first take your risk profile into account. Then look at the number of years your goal is there. Look at the returns you're expecting, then go backwards.